Hey everybody, this is Nick. Let's get this going. We are doing the January review, January issue 1A on the Trader Trend. And we're going to go here, go over the disclosure. We already got that. And let's run back to the actual playbook itself. Here we go. So, going through here, we had the market expectations for January. This came out, I believe, January 2nd. Everybody should have got it in their inbox, and um, and we're just going to kind of see how we did. So let's go through the market expectations for January. For anybody new, kind of the way we do this is just go through market expectations, and then every couple of weeks we review the previous trader trend review, which typically has options expiring 2 weeks after um, 2 weeks after the issue comes out, and we just kind of see how we did, and also talk about execution and talk about how the playbook really works, and just make sure that we all know how to do it, and we all know how to customize it in our own way because it is discretionary as well. So remember, everybody, results will vary, and I really want to stress that point. Uh, and kind of tell you how I do it. Also, if anybody has any comments or questions about it, you can always follow me on Twitter. The actual my actual Twitter link will be um, in the actual section, on this thing on YouTube. So that being said, here we go. We have the market expectations for January. Well, the end of the year basically ended as we expected within the 4,500 to 4,100 range, with some end of year rebalancing to keep us off the low end, which allowed the investor trend suggestions to absolutely kill it in Q4. And we will do investor trend once a quarter as well as far as the review there. That said, 2022 is in the books. 2023 is a blank page. 2023 should say goodbye to the range, the lower end way more susceptible to being breached in the upper end. Remember, almost all of that end of year buying was forced buying. Many pension funds and their like are, we'll call it, compelled by charter to buy via rebalancing. With the market down almost 20%, that means they had to buy S&P and P and sell things like metals and bonds, energy that fared much better. Unfortunately, the mechanism is no longer there to support equities. Sure, history post to post New Year buying, but that can be short lived. And given the state of things out there, both economic and political here and abroad, it is likely any pop will be sold into, a restraining factor being the upcoming jobs report, where bad news will be viewed as good. The market is starting to get the misplaced comfort in the market. It has already fallen, but that's not where markets bottom. They bottom when the comfort turns to panic, and we aren't there yet, not even close. Housing has only given back a third of its recent gains. No one's even talking the possibility of giving back all of its gains yet. The market has real February 2001, June 2008 feel, though we don't think the downside potential is as large. But hey, we could be dead wrong. Jobs report could be a disaster. ISM could become away under 50, and the Fed could do a 180 out of the gate. It's unlikely. Honestly, the beginning of the year is a crapshoot, and January has some really impressive moves recently, from up 7.9 in 2019 to down 5.1 in 2016. Bottom line, higher volatility means going for the investor trend suggestions where the suggestion is neutral. The strikes the short puts are far enough out of the money to give you either great accumulation levels or money in your pocket. And continue grabbing those featured investor suggestions for the same reason. Get great accumulation levels or it runs to target for minimal cost. The investor trend suggestion goes for everything, equities, both domestic and foreign, metals, bonds, commodities in general. Everything, even the investor trends that are bullish. Just selling the put and ignoring the call put bull call spread feels like the most prudent choice for now. And if not, and the market runs, oh well, have your stops in and let's go. So moving forward, what we'll go through here is going to be all of the trader trend suggestions. So there are investor trend things on here. We'll review those later. But going through here, we're going to be looking at everything that expired, had expiration dates on Jan 20. All right, so I'm going to pull up a chart and kind of split screen out here so we can kind of see what happened. And looking at Meta, right? If I squeeze down to kind of when we got the suggestion, right? And also what happened throughout that time. So the expiration was on the 20th here, and the entry was here on the 3rd. And so the recommendation here was to sell the Jan 100 naked put, which we did. If you had got in, it went for 36 cents. stops were at 174, and it paid. So you got the units back. If you had to bid them back for a nickel, you would have got $31 per contract on that. It definitely never got stopped. Selling puts turned out to be the right call, went straight up. So going forward into HYG. So HYG, we look at the trader trend. Now, again, you guys, going through how we really do this, the trader trend here suggests it was neutral, right? So if you were aggressive, you would sell the 75 call with stops at 74.65. But if you are conservative, you just maintain cash, which means guess what? Don't do anything, right? So this is up to you. Now, the way we tracked it was to enter all the trades, look back and see what happened if there was an aggressive move on this or get an aggressive trader on this. So we'll go to HYG, and HYG popped up here. And if I scroll back, right to where the entry was, you would have got 52 cents entering at roughly at 74.11 with a stop at 74.65, right? We definitely got stopped out of that. And if you had done it, you would have got stopped out for roughly a $10 loss. You got stopped on the 4th of January. So it was a pretty short stop. Again, the price opened at 74.11, which was right there on that this green candle here. The stop was right above it, so you really didn't have much risk going on. But again, we definitely recommend that you wait for these things to get a little bit of distance just to heighten your actual percentage chance of winning this thing. Okay, so on that one, probably wouldn't have taken it with such a tight stop and coming in so close to it. But again, we're going through just kind of see how we did. So next one is TLT. Again, TLT, we had the aggressive move was to sell the 105 naked call with a stop at 104.76. Conservative traders would have just stayed in cash. So we'll see how TLT did. So TLT going back, here we go. Would have got in right here at what price is that? 106.95. You're definitely selling that. So let me go. Oop, I just lost my track on how I was running this thing here. Um, yeah. So actually, oh, I'm sorry. Let me go to the right actual date. All right. So TLT actually was 102.20 when you would have got in. So if you had entered that trade, you would have got 92 cents in uh, premium, and you would have got stopped out as price continued to climb up for a 73-cent loss. You would have got stopped out on January 6th when the options price was about 165. So again, that one went to a stop if you were an aggressive trader on that trade. Going forward to LQD. LQD, again, same as the other bonds here. You would have sold the 108 naked call with a stop at 107.16. So let's see how LQD did. So going back to LQD. LQD, you got in at 106.95. So that was the entry price there. And if you got in at 106.95, your stop was again only 107.16. Um, and so it was very, very close. And you would have got 75 cents of premium for it. As you could tell, price went straight up again, and we took a stop on that on um, but you would have taken a stop on that on January 6th as well. Okay, so that went straight up too, and again, it was so close, right? So I mean, it opened at 106.95, and you got stopped in 20 cents later. So again, giving these things some space gives you, for the most part, a little bit more certainty that it's actually going to play out for you. Okay, so going on to EFA. Now, EFA, we go to the trader trend here, and you see on this one it's a little more complex than the other ones because it actually is bullish. And so what you're doing here, and the only thing that's really, if you're going to play these things, is to sell the naked put. Now the naked put is just the play, right? That's the bullish play. You're just going to sell that naked put. You're going to put your stop in here, as it says, place conditional exit for the naked put at 64.02. Now, if you're hyper aggressive, right, very, very aggressive, Then you do the bull call spread, which is going to make, remember guys, a long call and a short put is in synthetic stock. The short call on the bull call spread is going to make it to where basically you're creating a synthetic covered call. So from here, if you're going to do the bull call spread, then you're going to wait for price to drop to 65.96 or below, and you're going to target at 71.77. You're going to enter there, and now everything gets stopped though at 64.02. So looking at how this one did, we'll go to EFA. All right, so EFA, it opened at, go back here, 66.50, it looks like, right? So we got in, or I'm sorry, 66.46 is where we opened. So 66.46, if you had a sold the bull call spread, you would have got 75 cents for it. And if you had have went and done the bull call spread, it actually was filled, right? Because you were getting into that trade at uh, below 65.96. So it opened right at 66. Or, I'm sorry, it opened at 66.46. So you would have waited for it to drop down below that to. Am I on the wrong date here? I'm sorry, you guys. Oh, I'm sorry. Oh, it's right here. This is the opening candle. So this is the opening candle where it opened. I'm sorry, my notes are a little bit screwy, but I got it. So this is the opening candle. It definitely dipped down to get you in that bull call spread, right? Because you wanted to get in below 65.96. So it dipped down to 65.90. You would have got filled on that bull call spread. And if you had got filled on the bull call spread, um, you would have actually ran right to profit. So that thing ran all the way up for $420 in profit, and the obviously the short put went out too. So that was a big winner right there, right? You got the bull call spread hit, and you also had uh, the actual short call go out at um, obviously like at expiration, or you bid those short units back um, for a nickel. So again, big trade there. It ran all the way. Did it go all the way to the high? Let's see. It did 71. Yeah, 71.82. So I'm sorry, it's on the 20th there. Okay, it didn't get actually to seven, so we've got 71.68 before expiration. But that thing was so deep in the money that you could have got out at any point. And if you had to take in the vert, uh, even at close, right when the thing was expiring, that was actually the minimum you make was 420. It could actually got higher. So that trade worked. A lot of profit on that one. Um, so moving forward, and again, guys, I apologize for this thing. I'm just on my iPad, so I can't set it to lock in the actual date, so we got to kind of do our best with when we start here, and then I kind of look at where the expiration date was. And so bear with me a little bit. I'm able to figure this out in uh, upcoming reviews, but I'm sure you follow on this one, right? You would have it opened here, you would have sold the 65.50s, and then you would have put on the bull call spread when it dipped below 65.96. If you were hyper bullish on this with a target of 71.77 up here, and then you could have rode that whole thing up and almost maximum, almost hit profit target, but you would have possibly gave back a little bit, or you could have pulled it here. Again, there's some discretion here on when to take these trades, and but you're always going to get your short units back for a nickel. So you got to make sure that you do that. That way, that call is basically just a long call that you're riding up. Okay. All right, so going to EWW. EWW for the investor trend, similar to EFA. Or, I'm sorry, for trader trends, similar to so trader trends, bullish EFA or EWW was neutral. Okay, so on the neutral one, we don't have the same options to do the vertical. It's just if you're aggressive, you're gonna sell the 49.78 naked call. If you're conservative, you're going to stay in cash. And so let's see how that one worked. So going to EWW. So EWW, if we go back to entry, uh, on EWW, it opened above the stop actually. So stop was 49.87 to sell the call. Price actually opened at 50.50, and so you would not have wanted to get in that trade. Okay, or actually you wouldn't have gotten it at all because it's already stopped. So moving on to EWZ again for trader trend. If you're aggressive, excuse me, if you're aggressive, you were selling the Jan 30.50 naked call with a stop at 30.09. If you're conservative, you would have stayed in cash. And let's go to that. See how we did there. Z. Okay, so going back to entry. So EWZ, it opened at 26.71, and you would have gotten 15 cents credit because you were well under the 30.50. And that trade actually ran and got stopped out on January 18th, and you would have lost $10 on that one. Okay, so moving on to GLD. Here we go. All right, so GLD for the trader trend, you were going to again, it's one of the ones where you have the option to be hyper bullish because we're in a bullish, bullish trend here, and to buy this call vert if you get a conditional entry where price drops down below 166. But if not, you just sell that January 166 put on the Monday after you get the playbook with stops at 163.57. So let's see how we did. GLD. Going back to here. All right, so GLD, there was no entry as price. Or I'm sorry, there was. Okay, so yeah, actually, it opened up at 171.32. So when it opened, you would have sold the naked put, and you would have gotten 55 cents for it. It never actually came down far enough below 166.26, as you can see, in January, in order to get filled on the vertical spread. So you would have just gotten that 55 cents back. All right. So going on to silver. Silver, you would have sold the 2050. And if you were again hyper bullish, then if price fell below 2073, if it did, you would have put on this bull call spread here. Stops at 1984 for the entire thing. So let's see how we did there. All right, so going back, price opened for this at 22.45. So and you would have got 15 cents of premium on that. Um, the the actual price, did it ever come down low enough? No, it did not. So price never actually came down low enough. There was no entry on the vertical, but you did get back the premium on the short units for $15 in profit there. And again, if you're gonna bid back these units for a nickel or less, maybe something like silver, like 2 cents or something, just because it's such a small contract or such a small such a small derivative that you can get right there too. So, or you just let it go and expire. It's kind of up to you on that one. All right. Going on to XME, you would have sold the January 51 naked put. And if price went 51.34 below, then you would have put 51.56 bull call spread on. Stops at 49.66. Let's see how that worked. XME. So rolling back. Okay, here we go. So on XME, price opened at 50.13 here. It's right here. So price opened at XME, price opened at 50.13. You would have gotten $2.26 of premium for that. Again, remember stops here were at 49.66. So you pretty much immediately got stopped out, right? So it went down, boom, knocked you out, and then it crawled on up. So it sucks, right? You got just hit right there to get out of that one when price went screaming higher. But that's the way cookie crumbles on that. And if again, you were really close to the stops. So this is kind of one of the ones I was talking about that if you had to just waited, right? Because that opened at 50.13. If you had waited a couple of days, let this thing get above 51, even let it gap up here, then you would have got a little bit less premium on those short puts. But guess what? It never, ever even came close, and you would have ran that back. So it's a great example of one of the ones we want to do um, in order to, really try to really try to get a higher likelihood of actually having these trades be successful. I mean, you had to let it go up to, even if we had to let it trade back through the entry, right, which is a big practice that I like to do, something I learned a long time ago, kind of breakout trade. If you had to let this thing come up and then at 51.34, you just put the whole thing on, right? You would sell the naked put and then you would, you just put the whole thing on, make a synthetic covered call. And, that sucker ran all the way to target. So, I mean, it was a big trade if you had been patient and not gotten in when the thing was too close to the stops. Okay. So I hope you guys kind of really saw a good example of why I keep harping on that, and we'll see more of them too, because I've been doing this for a while and these pop up quite a bit. So going forward to XOP, XOP, it was a neutral recommendation. If you're aggressive, you were selling the 141 call. Conservative, you were maintaining cash. Let's see how we did in XOP. All right, so XOP, if we run it back here, XOP opened at 134.01, and so you would have gotten $2.37 credit on that. And then on the 17th of January, you got stopped out. But still, because you had all that time before the 18th, uh, you would actually have kept $57. So that actually was one where you got stopped, but theta worked in your favor, and you kept partial profit. Okay. So going on to XLE, XLE is bullish, and so you wanted to sell the Jan 87 naked put, and then if price went below 87.63, you wanted to put on the 87.97 bull call spread here with a target at 97.02 and a stop at 84.50. So let's see how XLE did. So, all right, so XLE, we go back here. XLE opened at 86.92, and you would have collected $2.38 profit on that. And that one actually went, and again, it stopped us out, right? Because it stopped you out. So if you had got in, right, it went straight down. So, when it opened at 86.92 and the stop was at 84.50. Now, we were definitely below, the price was definitely below the 87.63. It was close enough to take it. I don't blame you if you had done this one. You were actually pretty good from the stop, but it just kind of had this pinned down. Um, Up to you if you wanted to re-enter. Who knows if it had went up or not, but you could have done it, taken that quick stop out, and then when it again breaks above the the entry here, you can get in with the whole spread over again. But if you had done it by the book or automated it somehow, would have taken a stop on that. The stop looks like it would have been, if you had played it strictly by the numbers, $162 stop on the short puts, and then if you had have gotten in the bull call spread, it would have been an additional $115 stop. Okay, so moving forward to DBA. DBA is a bullish trend here as well. So you would have been selling the Jan 20 naked put. And then if price dropped below or was below 2027, you would have entered the 2021 bull call spread with a target of 2073 and a stop at 2012. So let's see how DBA did. So going back. So DBA opened below the stop. All right, so it opened up right at 2011. Stop was 2012. No entry, no trade on that one. Okay, moving forward into XBI. XBI trader trend is bullish as well, so we're looking to sell the Jan 83 naked put, and if price goes below 83.45, we are putting on the 80, or you would have been putting on the 83.88 bull call spread with a target at 88.06 and a stop for the whole thing at 81.92. So let's see how XBI. All right, so XBI looks like it opened at 83.93 with a stop at um, 83.93 with a stop at 81.92. So that there was the entry right here. And again, this is another one that kind of just pinned straight down and stopped out on the first day. But again, it's one of them that there's a potential re-entry if it came back up if you want to do that. But again, by the books. If you had got into this one, then you took a $98 stop on the short 83 put. And if you had a went in the bull call spread, then you would have got stopped out for an additional $45 on that. All right. So moving forward into VNQ. VNQ trader trend was neutral. And so aggressive traders would have sold the Jan 87 call with a stop at 86.45. Conservative traders, again, would just stay in cash. So let's go VNQ. All right, so VNQ, if we go back here, VNQ opened at 81.66, and you would have got, I'm sorry, it opened at 83.16. My bad. It opened at the low. So it opened at 83.16, and you sold those calls for 41 cents, and then you would have got stopped out for a $72 loss on January 11th as price climbed up through it. Okay. So moving on to XHB. XHB trader trend again was neutral. Aggressive traders would have sold the 61 naked call with a stop at 60.36. Conservative traders staying in cash. So let's see how that one did. XHB, Gold Home Builders. All right, so it opened actually at the stop. So guess what? You were not going to get in that trade. Trade price opened at 61.29. So not 61.29, but 60.36. So it opened around the stop, and you wouldn't have gotten into that trade at all. All right, so XHB is no go. Okay, moving on to the major market indices. The SPY here, trader trend. Aggressive traders would have sold at 391 with a stop at 390.12. So let's see how SPY did. Start off the year. So SPY opened the year at 384.37. You would have collected a $4.76 premium for that, and then subsequently been stopped on the 9th for a $104 loss. So it held on to it for a little while, but then eventually it broke out. It stayed down for a bit. Going on to the Qs here. Aggressive trader, because we're still neutral on the trend here. Aggressive trader would have sold the 284 naked calls with a stop at 283.64. So let's see how the Qs held up to start the year. All right, so the Qs opened at 268.65. You would have sold those. You would have sold those 284s for $1.33. Price eventually got stopped out on January 18th. Um, Theta did help you, and you only took a $72 loss on that one, so partial loss from Theta decay as that thing ran up and then took you out right here on the top here. Okay, so and then last but not least, we got IWM. IWM again is aggressive. If you're an aggressive trader, you sold the 180 call with a stop at 179.59. Conservative traders would have stayed in cash. So IWM. So IWM opened the year at 175.93 right here, and then you would have sold those 180 calls for 232. And you got stopped on January 9th again for a partial loss at $83 as price went up through the stop. So, all in all, I'm talking to where all my aggressive traders at. If you had have taken everything, you would have netted a $415 loss on this playbook. Now, conservative traders, if you had have really, I didn't actually add it all up, but if you go through and kind of look at all the maintained cash positions on the neutral trends, you probably actually were green. I haven't gone through and chose that yet, but it seemed like a heck of a lot of these losses happened on aggressive traders and a neutral trend here getting chopped up. And so again, you guys, this is discretionary. There is still some skill, right? We got to have as traders, and we're developing it. We're learning. This is very much a powerful, powerful way to manage risk. It's a powerful way to maximize big moves in the market. It's a big way to get longer on areas of accumulation or to collect passive income when price is waiting to get to big areas of accumulation. So, going through, we'll continue to do these. I hope that I'm getting better. I hope you guys are understanding it more. Please, as always, like, subscribe, follow me on Twitter with the information that I'm going to put down in the their comments section. I will answer anybody's questions. Critiques are great too, so please let me know anything I could do better. And safe trading, everybody. We'll see you next time.